So, welcome to our Q&A on the federal budget for 2021.
Our first one live.
Yes, we always do our wrap-up video the morning after the federal budget, which is generally a lot of fun to actually put together, wading through the budget papers the night before and trying to actually work out what is relevant and exciting for small businesses versus kind of what information is announced that you literally have nothing to go on, because it's an announcement with a lot of consultation to come in industries in the future. And last night was very much the same. So sure, there's a lot of tax related things that were announced that, you know, we actually knew about last year, or at least before the budget, because I think everything was pre-released. But there is an enormous amount of spending that was actually announced in the budget as well, but there's a lot of gaps for exactly how that spending is going to happen, which will hopefully, fingers crossed, be filled in the next little while.
Yeah.
So again, for those of you who just joined, if you throw your questions into the Q&A box, so literally just down the bottom next to the raise hand button, there's a nice little box that says Q&A. Pop that open, type in your questions, and we will endeavour to get through all of them tonight. But let's kick off maybe with the first question that we were asked earlier in the day.
Sure.
And that was, do I need to update anything in Xero for the changes to super? And they're talking about the increase in the super rate. So let's just go through the super rate quickly. What's happening there?
All right, so from 1st of July, we're going from 9.5% up to 10% of gross salary. So that will be changed effectively immediately in Xero when you run a pay run after the 1st of July. And also there's the proposed change to remove the $450 minimum earnings for starting to accrue superannuation. So as soon as that is made legislation, Xero will be updating that immediately for people to run payroll as normal.
And that 450 won't come in for the 1st of July this year. That'll be a future thing. But again, 1st of July 2022, it sounds really bizarre and weird to be talking about 2022 already. Feels like yesterday we were just starting 2021. But Xero basically have all of those things updated, ready to go for the 1st of July. Likewise, the income tax rates are always updated each year. So the benefit, obviously, of using Xero is it is cloud accounting. As soon as they update something, there's no, you know, getting that old CD or however they send it to you nowadays and having to upload tax tables and payroll details. That's all automatic. And thank goodness.
Yeah, no one's got time for that anymore. I think one of the big things with budgets these days is what's announced then becoming law and then the effective date of it. So it gets quite confusing for people. So one of the things we spent a fair bit of time on today was going through the budget papers in detail and putting in our blog post the dates of the effect of each announcement. So if you haven't already ploughed through the documents yourself or received some other communications, if you head onto our website, you'll actually see our blog post summarising all of the announcements from last night with those dates so that you don't have to remember them. You've got a reference point to use that information.
Much easier. Now, on the super vein as well, but not so much in relation to Xero, the next question that we had is the total super contributions cap being increased to 27.5. How do we actually track that to ensure an individual doesn't go over? And this is a really hard thing, because if you don't get the timing of when you pay super right, then contributions will be allocated to a different year than potentially you're trying to get them allocated to. So for those of you who are employers, especially for your own superannuation, it's really important to do that timing right. So by law, you only need to have your June quarter super remitted by the 28th of July. In reality, if you want to claim a tax deduction for it, it needs to be paid before the 30th of June. Now, Xero normally gives us an update sometime at the beginning of June on when we have to have them processed in order for them to ensure that the contribution will be in the super fund before the 30th of June. And that really is the catalyst and earmark for claiming that tax deduction and also knowing where your contributions are up to for a year. So I guess first and foremost, it's important to get that super done before the 30th of June. So generally we're, contacting you like mad between the 20th and the 24th of June saying approve super, approve super. It's we haven't gone crackers. It really is important to actually get that done and get it done early so that you get that tax deduction and so we can understand when that super contribution is going in. Now the 27.5 obviously starts on the 1st of July. So we can't do any more than 25 this financial year. It needs to be into the next financial year. But it is important to plan the timing of those contributions because these caps are based on when the money goes in to the super fund, not when you press the approve button in Xero. And at the moment, it's taking at least 3 days for that money to show into a super account. The same time.
Yeah, and we do know from past announcements by the ATO that they don't like you going over those limits and they will tax you accordingly for it. And it's just annoying for all parties involved if they do go down that path. So being able to pay attention to that and get stuff paid on time, as Steph said, is really important these days.
All right, something that is not super. The next question in the bucket was how far back does the temporary loss carry back go?
Okay, so just so everyone gets this in case it's been muddled along the way, if you make a loss, say this year, that loss normally gets carried forward to future years. So if you make a profit next year, you can use this year's losses in your tax return and pay less tax. The announcement that was made in relation to these loss carrybacks is to actually work backwards. So that if you'd made profit a couple of years ago and paid tax, that if you're making a loss in this financial year, you could claim that tax back that you've already paid. So it's actually cash back in your pocket when you're not actually making profit. So it'd be really good for businesses to actually have that cash back in their bank account. So the technical answer to the question is it'll go back to the start of the 2019 tax year. So if you paid tax in that year, made a loss in 2020 but didn't claim it, you'll have the 2021 year to start using that clawback provision and get the cash back into your account.
And I guess this really does go hand in hand with the instant asset write-off so that, in 2019, if you made $500,000 profit and now in this year you've decided to go and get a robot to help with your manufacturing plant, to automate things. Alan does a really good robot. The whole idea here is you might have spent, $600,000, $700,000, $800,000 on equipment. With this instant asset write-off now, you claim that in a year, which is likely that may push you over into making a loss. So it is helpful then to be able to actually claim the tax that you've already paid against that loss and against those costs. Yeah. So the two really do go hand in hand. And obviously, certainly the 2020 year with the last quarter being COVID and certainly this current year, there's been a lot of government stimulus flying around. It is important to note that JobKeeper is taxable income. The cash flow boost is not, depending on the grants that you got from different states. Some of them are taxable income and some of them isn't. So I know for us, we've got a lot of clients who are making super profits this year because everybody kind of buckled down and did everything they could to shore up that revenue, to reduce those costs and to really do everything that they could to be in a good position. So there's certainly a lot of profit and cash flying around. We are not going to have many people who are even eligible for the loss carryback rules, but in that rare occasion where you have an opportunity to go and spend money on equipment before the 30th of June, and it makes sense because you know that it's really going to help improve efficiency, gross margin, profit at the end of the day, win some new contracts, and you can afford to fund it.
That's the important thing.
It's really important. None of these things are actually handouts from the government. You still have to pay for everything. So if all of those things line up, then potentially it is a fantastic idea to go out and spend that money. And this is just something else that you can utilise to help in that process as well.
Beautiful. The next question that came in was, what's the apprenticeship wage subsidy and how does it work?
Well, this one's already in play, and we seem to be doing a lot of them every quarter. So the apprentice wage subsidy has been in play for quite some time now, and it effectively is 50% of your apprentice or trainee, because it's both, wages back at the end of each quarter, up to a maximum of $7,000, and you claim that for 12 months. So in reality, let's say you have a great opportunity right now to put an apprentice on, ready to start, say, on the 1st of July. They went to year 11, they hate it, they're ready to go out, actually do an apprenticeship. You could put on the apprentice on the 1st of July. You would pay them their normal wages for the first quarter, so July to September. At the end of that quarter, your training provider would be sending you a whole host of documentation for you to complete. You would lodge an application and you would be repaid 50% of that apprentice or trainee's wages. And that happens for 4 quarters, so for 12 months. Yeah. The good news is that was legislated to stop, and that's now going to continue to the 31st of March 2022, yeah, which means that you can be employing apprentices all the way up to March 2022 and still getting the full 12 months.
Yeah. Part of the cash splash.
Yeah, so it's a good opportunity if you are growing and you do have an opportunity to actually utilise apprentices. We're effectively talking about a 2-for-1 deal.
Yeah.
It is important, though, that you understand the cash flow, because whilst we can say it's a 2-for-1 deal because you're getting 50% of the employee's wages back, you have to be able to fund it. So you've got to pay the wages for the quarter. By the time the training organisations are sending out the package, by the time they're processing it, you know, we're at least 4 weeks, sometimes 5 weeks past the end of the quarter. So yeah, not exactly helpful from that perspective. So again, make sure you can fund what you need to.
Yeah, always a good rule for decision making. Can you afford it? The other thing that's come up new, but it's not new globally, but it's new to Australia, is this thing called what's the patent box and its benefit? How does that actually work in reality? Well, goodness me. This space looks at innovation and R&D. So what businesses are actually doing out there that are creating a real benefit by doing it usually through a registered patent and trademark and being really innovative in their work. So the way the government proposed this last night was that starting with the medical and biomedical industries, they're going to reduce or give you a rebate on the tax for the income that you earn from the patents that form into this box style mentality, so that your effective rate of tax from earning on that would only be 17% as opposed to the corporate tax rate. The devil is always in the detail though, so you really have to pay attention to it because you have to be able to identify the income that's generated from that patent that you've created. So if there's other things that you sell after you've created a new product or service that aren't in direct relation to that patent, then that reduced tax rate doesn't apply. So make sure everyone that's even contemplating that is actually keeping the appropriate documentation in place.
There'll be a huge amount of consultation in terms of industry because the draft, I guess, or the little bit of information that's out there, it's certainly not legislation, points to the fact that if you're actually manufacturing So if you're earning income from physically producing and selling the product, then it's only the portion of the patent income that you're actually going to get this 17% deduction for. So, there is a lot of R&D laboratories that don't actually do any of the manufacturing. They obviously just have license agreements. In that case, 100%, it will be really helpful. Yeah. The disappointing thing for me is this is all well and good, but we're only talking about at this stage the medical effectively, that's right. The medical industry. There was an off-the-cuff statement that clean energy potentially might now fit into this box as well. So they would start to do some industry consult from that perspective. But still, it's very light on, and Australia has a lot of other industries, especially from a manufacturing standpoint nowadays, that it'd be nice to have seen something else.
Or something just across the board, regardless of industry. So I think it's watch this space. It's a good start, but it needs to evolve to be more inclusive for the rest of the community.
Now, what's happening with intangible assets?
Well, what a great question. So intangibles, this is actually relates a little bit to the previous question, but it's in relation to patents and trademarks where you would previously have to write them off over the ATO's standard rate. So some of them are up to 20 years writing off, which, in the past may have worked, but in reality these days, the rate of change of technology would suggest that, these things sometimes have a shelf life of 12 to 18 months and they're redundant and are superseded. So what they're allowing you to do is to it's self-assess or have an immediate write-off for that expenditure so that it actually comes in line with the way the business is planning to invest in innovation. So it's a good step forward. So watch this space as well.
But again, 1 July 2023, not coming in until the instant asset write-off is finished. So it's a long time before we actually get to utilise this or do anything with it.
Yeah.
Now, this is my favourite question because I found it hilarious. Does the gaming tax offset mean that I can claim my Xbox subscription as deduction?
I love Australians. Straight to the creative.
I think the short answer would be no.
I think that's pretty fair.
But good effort for creativity in trying to claim Xbox, and it also does mean that the answer for PlayStation and any of the other gaming consoles would definitely be a no as well. There is another question though that we were asked in relation to this gamers tax offset, and I've got to tell you, I was astounded at the statistics that they put out last night to say that game development as an industry is $250 billion and is a huge growing market in Australia. So there you go, fun fact, learning something new.
Yeah. And a good initiative to bring that industry and keep the talent in Australia. So a lot of people I know currently that are talented in that space have been poached to Silicon Valley and into Europe. So it's good to see the government starting some initiatives there to try and keep that talent back in Australia and give people credit for it.
Yeah, so the other question was, what's the tax offset for game developers? It simply is a 30% tax break on eligible Australian game development expenses.
Yep.
And you have to ensure that you spend at least $500,000 on game development in Australia in order to qualify. Now, interestingly, this has been said to be a really good thing for exports because Australia does export an enormous amount in the gaming industry. So the more obviously we can bring people into Australia, the better. And another interesting fact on this, South Australia was really early to lead this race, well before this 30% tax offset was announced in the federal budget. South Australia already has a 10% offset for people actually setting up game development studios, or I'm not sure what you call them, but setting up in South Australia. So what a win. That's effectively 40% for people who are doing this in South Australia.
Yeah, and hopefully bring some like-minded businesses together to create a bit of an ecosystem for them.
Now, one that is dear to our heart.
It's my favourite question so far.
What's the tax break for microbrewers and distillers?
Yeah.
And how does it work? i.e., the question says, am I getting cheaper beers?
Well, that's not guaranteed. For the microbrewers and distillers, it means their excise is being reduced. So they're getting, just like we have with income, they have a tax-free threshold for the first $350,000 worth of production, so that they won't have to pay excise on it, which is really impressive for that whole industry, because as we know, like the craft gins and the craft beer distilleries, that sort of incentive that they're offering those people is actually really helpful, because, you know, the cost of excise on all forms of alcohol is quite extraordinary in Australia. So being able to give them a bit of a break in relation to that's good, and encourage them to keep their production levels up.
And the exciting thing as well, because it's a 100% offset, there's no outlay at the beginning. So there's no cash outlay as well. So I believe we're drinking a Melbourne gin tonight.
Cheers. Maybe another one later. Cheers, everyone.
Cheers. We definitely support the this in terms of microbrewing and distilling, getting a nice break. And it's such a good growing industry in Australia as well. There's a lot of people doing well in exporting as well as in Australia. So we say bring on more beautiful,
keep it coming,
small batch gins, right?
We'll keep trying. You keep producing.
For those of you who are in Newcastle, on the gin story, there's actually a really, really good gin that Sticks Brewing do that was made for Nagisa, the Japanese restaurant in Honeysuckle. It is absolutely delicious. So Sticks, you can order it online now and they will literally deliver it to your door. I think the last one we ordered, it was here in about 5 hours. Yeah, so
it was great.
Highly recommend.
Tried it for lunch, had it in the afternoon before dinner.
Great gin, as are most of the Australian gins as well. So if anyone ever has any questions about alcohols to try, I think we're qualified to give some opinions in that space.
And happy to keep trying, by the way, just putting it out there. Anyway, moving on. The other questions we've been having are around asset purchases and, you know, these catchphrases that are being used. So the question itself said, what's the temporary full expensing measure and what's changed? So
3 down for another question we got just after that is, can I buy a ute and get my money back? Which, no, the answer is no. But those two questions kind of go hand in hand. And whilst we love what the tax office has done in making it easier to understand the tax deductibility of certain things for small businesses in particular, this is not a handout, right? It is a tax deduction. So the rule that's been in place already is you can buy any asset. So you can go and buy, as we've said, a robot. You could go and buy a massive piece of farm machinery. You can go and buy a ute. It is allowable. And instead of claiming those things over a number of years, so let's just say you purchased something for $100,000 and the effective life was 5 years, you'd write off $20,000 a year. We'll just do a simple example, which means you'd claim $20,000 a year as a tax deduction. With these new rules, you claim the whole 100% in this year. So as soon as you physically buy it, which is a great tax deduction, because if you're a company, you know, and you're spending $100,000 and you're saving $26,000 in tax this current year, right? So it is good, but you have to be making profit. So that's really important to understand. For this to be of any benefit for you, you have to be making profit. And it's not a tax offset. It is simply a bringing forward of your tax deduction.
Absolutely.
Because I can still claim that piece of machinery, $20,000 every single year, and not actually have any problems with that.
Yeah.
So it's kind of really important to make sure that you're making profit for this to be of benefit, but B, you can finance it. And I think the big thing that I'd like to hit home is that it makes sense for your business. Right? Buying a ute is great if you need one. Right? If you actually do need one to do your job properly and yours is out of warranty or costing you tons of money from a repairs and maintenance perspective, or your business is growing and you've got 5 new employees to put on and you at least need one new ute, that makes perfect sense.
Yep.
But it doesn't make sense to just go out and spend money willy-nilly. In my mind, this really is great for buying those pieces of equipment, and we keep harping on robots, but it's so true. Buying the pieces of equipment that can help build your scalability from a manufacturing standpoint, or build out what you actually need to do to get to the next level, or, you know, not have to go and employ 20 people by having somebody, or be able to do 24/7 manufacturing of certain things. This is really helpful because you get that tax break now. If you're profitable, interest rates are terribly low. So again, it will sometimes make sense to do that investment now, but it's a case-by-case basis.
Absolutely. And I think there's a tail lag there that's often forgotten when people look at the immediate write-off. That's great, but it also means that for tax purposes, if you sell it later, if you've got no cost base left on the vehicle because you've written it off already, you actually will pay tax on the value of the ute, if we use that example, when you sell it at the end of the day. So there's a tax sting on it at the end if you're forgetting about it before you make that purchase. So by all means, as Steph said, if you need it, absolutely get it if it makes sense to you to do it right now, but just be aware that there are trade-offs for that.
Now, there's another question. I heard something about self-education expenses. Can I claim all of my training and university textbooks?
Well, one of those little quirks in the tax system, wasn't it? It was like, it's been around since I started, which was 20 years ago.
Don't tell people how old we are.
You used to have to basically give away the first $250 of costs that you had for your deductions. Didn't matter whether they were textbooks or union fees or stationery or other things like that that related to the course that you were learning. The first $250 was non-deductible, which never really made a lot of sense, but the government must have thought similar to me, because they've actually now proposed to remove that first $250 throwaway, let's call it, and be able to claim those sorts of things straight up front. So that is a step in the right direction.
So yeah, nothing has changed though in relation to university fees. So those course fees, they're still not deductible. But of course, your textbooks and everything else that go along with that are, and any other courses that you would do, certainly short courses.
Absolutely.
There's a lot of people doing those at the moment. But again, they've got to be in relation to your current position in your job. They can't be for you getting another job.
Yep. And I think one of the big things about last night, which is one of these new questions that are coming in now, is there anything special for tourism businesses, which would have been lovely to see, as we've got a couple of clients that are in that industry who have been dreadfully affected through it. The short answer is no, not directly, unless you're impacted by being able to get cheap flights into your area or organise those. So there is a small trade-off and flow-on effect for you, but until we get some more clarity about where you can travel and when you can travel, I think it's going to be tough going for that industry, unfortunately. So it might be a watch this space to see how government responds to some pressure from the industry.
Definitely. And it obviously is hard. You know, there are some areas where, because people can't travel overseas, you know, everyone is traveling in Australia,
Absolutely.
Which is fantastic because we live in such a beautiful country. And so, you know, some areas on the east coast of Australia, you cannot for the life of you even get into a town at the moment because everyone is going there. But likewise, there's a lot of places that aren't having the same luck. So I think it definitely is a watch this space from a tourism standpoint, but nothing exciting announced last night either.
All right. Now, someone who must be a little bit politically minded said, when's the next election? I don't actually know that yet, but we'll let you know when we find out.
I think talk on ABC this morning was they were taking bets on will the election be called after a budget next year? So will a budget be brought forward?
Yeah.
Or will we actually go before the election? None of us know.
It's all right. It's out of our hands. The other thing that's been interesting, and particularly in the media, is the focus on women in this budget. Now, I think when you look at the legislation and the proposal stuff that came out, I don't think anything was specifically written for women, but women are certainly going to be beneficiaries of some of the initiatives that have come out. So what we were talking about before about removing the minimum $450 to start accruing superannuation is coming into place. There are some specific announcements that the government's made to allow people, particularly single parent families, so that could be single fathers as well as single mothers, where you've got a low household family income, to put down a deposit of up to 2% instead of 5% and be able to have the government come in and guarantee the rest of that deposit to be able to get housing finance. So there's a lot more detail on that on our post, and there'll be more detail forthcoming from the announcement. But that whole movement in that housing space is probably one to watch, because I'm sure anyone that's listening tonight can attest the price of houses has gone absolutely bonkers. Agree.
So it's good to see some assistance there in terms of getting people into housing and being able to buy a house as well. Because I know in a lot of areas you're paying just as much in rent as what you are in mortgage repayments. So that's quite helpful as well. So we've just had a question come in about e-invoicing. So what's the e-invoicing program and how will it impact my business? So e-invoicing has been around for many years in terms of the government talking about it. And what it was originally designed to do was to fast track and simplify the process of doing business to business style transactions, and certainly to assist in this bottleneck of people getting paid on time. So if you deal with any large businesses or you deal with government agencies, by the time you send them an invoice in their pro forma format that has to be completely perfect, by the time it gets approved, by the time it then gets manually entered into one of their archaic systems that you still have to literally type everything for, people are getting paid in 90 days, and it's just not sustainable.
Yep.
Nor is it, conducive of new businesses coming into the mix and play and trying to do anything with government or big business as well. So e-invoicing is kind of a two-edged sword. It's to decrease that red tape burden of having to manually type things into systems, but it's also helpful for speeding things up. So Xero actually has e-invoicing live in their platform already. And what it does is it effectively puts your invoice, in layman's simple terms, into the other person's accounting package automatically. It streamlines all of the must have this type of pro forma invoice issues, because everyone is using the same platform or the same language for sending those invoices, which is quite helpful. And the aim really is to, by July 2022, that e-invoicing will be mandatory for all Commonwealth agencies. And at that point in time, they'll be putting in place some days of payment that will then be reported. So the government agencies will actually be reporting on the number of days it takes them to pay people.
Yeah.
Which will be fantastic. And look, e-invoicing for small businesses, I'm not sure it's going to revolutionise what they're doing from a processing perspective, because I know for a lot of you, we use Dext. It's your invoices in there. It's doing all of the heavy lifting for you. With Xero invoices, or if you're using another package for invoicing or any of those things, it is semi-automated, but the debtor days and those reducing, in my mind, will be fantastic.
Yeah.
So
yeah, and I think that's a big thing, particularly for small businesses that deal with big businesses. So having that process automated along the way and seeing some final automation in that space can reduce that risk of human error as well, because, you know, oh, sorry, I put the wrong number in. Oh, sorry, I didn't put that day in properly. Well, if that stuff's removed out of the equation, it's a much simpler conversation to have when it's time to pay the bill, isn't it? So,
yes. Now, we've just had a couple of other people join us. So if you have joined and you want to ask questions, make sure you drop down to the Q&A box, which will be at the bottom of your screen. Just click on that and you can then ask any questions that you like. We certainly do like the hilarious ones like, can I get a tax offset for my Xbox? So keep those funny ones coming for sure. The next question is, what is JobMaker? Now, I don't know about you, but I'm definitely sick of job something.
No more jobs, thanks.
Job keeper, job seeker, job maker, job trainer. I'm sure there's one I've missed there at some point in time.
Yeah, it's been an ordeal, particularly on the accounting side of the equation, just to try and keep up with all of the initiatives that are out there. But look, at the end of the day, these initiatives are all about producing jobs. So it's being able to incentivise businesses, whether it's being a direct offset for employing people or retraining them or upskilling them to be able to get people back in the workforce, because it's better for everyone when you're in employment rather than having to rely on some form of government handout. So
I think the government's been a bit shocked at the level of uptake for JobMaker. So just to refresh everyone, JobMaker is the one where if you employ someone between the ages of 16 and 35, you might be eligible for either $200 a week subsidy or $100 a week subsidy, depending on their age. Up to 29, it's 200, and from that to 35, it's only 100. The problem with JobMaker is you have to employ someone who has been on a form of Centrelink payment, basically, for at least 1 month in the last 3 months. And for a lot of people, when they were on JobKeeper, you know, that actually wasn't included as a Centrelink payment that would qualify for JobMaker. So because everybody was still effectively employed under JobKeeper, finding good people who can actually qualify for this is quite difficult. And I don't think anyone thought of the practical issues in that if you're an employer, you can't exactly advertise and say, please don't apply unless you are on, you know...
unless you'll get us some more money.
unless you're on a Centrelink payment. So it does become a bit tricky. And, you know, if you do advertise for a job and you are interviewing people, you will naturally pick the person who is best cultural fit for your business, especially for small businesses. It's so important. In which case it's really hard to sit down and ask someone, so in your interview, have you been on some form of Centrelink payment in the last, you know, 3 months? Therefore, might we get JobMaker for you? And I know that a lot of employers do that, but the uptake for JobMaker has been very low, which has been quite surprising, and probably why you see effectively next to nothing in the media about JobMaker as well.
Yeah, I think that's... And particularly some industries have actually been thriving throughout COVID, just to put a good news story in the mix, particularly the construction industry and anything to do with home improvements. It's almost like buying a car or a caravan. It's a 6-month wait to get anyone to come and look at things for your house. So people in those industries that are good leaders of economic activity are certainly busy right through to Christmas in our experience at the moment. So it's been good to get a general feel from the economy that people are getting back to normal, they are going back to work, and the reliance on initiatives like this is becoming less and less.
And to finish off the question, Job Trainer is really helpful for, I guess you would say, the the TAFEs of the world. It's designed to put money back into the training organisations, not just the TAFEs of the world, but definitely designed to upskill in things like aged care, in digital skills transformation, and is also targeted towards young people and getting them skilled and trained, ready for the workforce, as well as some disadvantaged people. Under the Job Trainer banner, there's a couple of $10,000 I guess you'd call them incentives or grants, where if you employ via an employment agency and that person has been an older Australian or on a certain type of Centrelink payment for a little period of time, you can actually get $10,000 for taking that employee on. So it has to be done via the employment agencies. But if you've got a need for somebody in terms of employees in your business, you need to explore, I think, is what's happening nowadays, because there are a lot of opportunities out there for those incentives, because the government just wants everyone to employ.
Yeah. Still got some more questions flowing in here at the moment, so we might keep going. Just remember, for anyone that's just rejoined, if you'd like to ask any questions, just click on the Q&A box down the bottom of your screen and just type away, and we will make sure that the people listening today are first priority in terms of getting answered. Question. My mate said I can fly to New Zealand from Newcastle. Well, a while ago, yes, you could, and then it stopped. And then there was COVID. But until we get the Trans-Tasman bubble across the line and people fully vaccinated and the government on board with international travel, it won't be set to return. We're looking at the moment until past 21, 22. So it's on the radar. It's part of what the government announced in terms of upgrading the Newcastle airport as part of the regional infrastructure spend. So it is definitely on the radar to take the pressure off Sydney, to allow us Navcastrians an easy way to get overseas, which we love. So it's coming, but it's not here yet.
66.1 million, I think, was what was announced for Newcastle.
Yeah.
Which is quite good.
Yeah, spend away.
And that just helps in terms of construction. It helps in, how long that will actually take to develop and build as well. So, yes, I would love not to have to go to Sydney to fly anywhere, but at the end of the day, we can't go anywhere anyway. So
yeah,
that's okay.
Yeah.
Road trips it is.
Road trips, camping.
The next question. We've got some good ones coming in. Keep them coming. How can I get more money from the government? I think that's a very blunt and pointed question. So there are a lot of grants available at the moment. We've got the modern manufacturing initiatives, there's the business acceleration programs, there's the Commercialisation Australia stuff that is happening, that has been happening for quite some time. None of those things are new, announced in the latest federal budget, but they are obviously things that are fantastic for businesses who are trying to scale, who are trying to grow, and who are trying to do innovative things, especially in that manufacturing realm as well. So if you're one of those businesses, it's not just a handout. You can't just do an application online. You will be paired with a person who is actually working for the government to come in and do those assessments, to write those grants and to get everything done. So there is a lot of money flowing around from that perspective. This budget last night announced a whole host of other money that was going to be earmarked to different projects. And what they seem to be doing on a rolling basis is they'll pick 4 or 5 categories of things that they want solved, so problems, and they'll earmark, $500,000 for a pilot phase, and then another 5 or 6 million for the prototyping phase to an actual problem that they're trying to solve. One of the problems 12 months ago was counting fish. So, they're picking a problem and they're allocating some money towards that because it's clearly something that is either costing money or causing issues. So lots of those grants available. Obviously, there are things that are happening. So, to get more money from the government, you could go and buy assets and get a tax deduction, which we've talked about previously. we do have the company tax rates going back to 25% from the 1st of July. So they're 26% right now. They were 27.5% last year. So great that they're reducing down. And there's a calculator on, I think, the budget website that actually shows you as an individual how much money you're going to get from the government with your Lamington offset. Still got to be the best name for a tax offset I've ever heard.
Just makes me hungry.
So that's the low and middle income tax offset. And so again, this has been in play. So you got it last year. It's $1,080. You're getting it again this year. Nothing new, but it was due to finish. So quite good.
1 year extension.
Yeah, another 1 year extension. So there's no job keepers anymore. There's no cash flow boosts that are just straight handouts from the government. We do have the Services New South Wales grant for people that are in New South Wales. That's yet another one. So we've had our original, we've had our marketing, now we have another one. Its aim is to subsidise the cost of registrations and licences and basically charges that you pay to the government, certainly the New South Wales government in any case.
Yeah.
So that's $1,500. It's already in play for anything that you spent from March all the way through to 30 June 2022, up to a maximum of $1,500. But you've got to have spent the money and upload the receipt.
Yeah.
So we'll be working through that grant over the next 2 to 3 months, because for most people they actually haven't spent the $1,500 yet. And so it is a registration process. The New South Wales government site had a few teething issues as we did a few tests. So
yeah,
we prefer sometimes, if it's not urgent and we know it's available until kind of that due date or that deadline, that you don't rush into these things and cause yourself more grief and heartache.
I think I was touched on this before, but another question came in. I'm a casual worker and receive less than $450 a month. My husband told me that my employer must pay super for me after the budget announcements. Is this true? Well, yes, but not straight away. So the proposal announced last night was that superannuation guarantee would start accruing from the first dollar of wages that you earn. So that is absolutely correct. However, it's not due to start till the 1st of July 2022. So there's another 12 months or 13 months to go before that will actually come in and start impacting on your superannuation contributions. But speaking on super, one of the things that was a big announcement in the space to try and simplify some of these stupid rules that are out there in relation, well, I call them stupid, but stupid rules in relation to super. So we know that concessional contributions are going up to $27,500. That's concessional means tax deductible for anyone that wouldn't understand that, or the non-tax deductible amounts going up from $100,000 a year, excuse me, to $110,000 a year. We're all trying to move along with the pace of inflation. So if you think about how we're increasing the rate at which we're paying super on wages, so we're going up to the 10% starting on the 1st of July. This superannuation cap's going up so that you can allow for those additional contributions that are coming in. It's just a matter, as we started at the very start of this evening, really targeting and paying attention to the timing at which you pay contributions, because the due dates for paying supers for an employer don't necessarily match the tax years that the superannuation contributions are reported to the ATO. So if everyone's not on the same page with that, then you can strike yourself with some tax issues around it. But things are moving in the right direction. They just need to move faster.
All right, next question. Has the 50% pension drawdown reduction going to continue in the 2022 financial year?
Yeah. So thanks to COVID, the government was really quick to announce that for the 2020 year, they're actually removing 50% of the requirement to draw down your pension for the year. So self-funded retirees in particular were able to only take half their pension in order to maintain that capital value of their super, which a lot of people certainly enacted upon. So that was then extended up in the last budget for the current tax year that we're in now, so for the 2021 income tax year. However, it is due to go back to normal from the 1st of July. So those days are numbered.
Bugger.
I
think that was definitely a curly one that didn't kind of get announced, or no one has said much about it at all.
No, a lot of the announcements in that super space have been proposed a few years ago, and because of the way legislation has either passed quickly or not passed and been fought through the Senate, the timing of that's almost running its own course. It's sort of sitting outside the government announcements. But I think when the industry itself is up to nearly $3 trillion in size, which is bigger than the Australian stock market. So if you can get your head around the size of the savings that we now have inside that system, the government's trying to make that as efficient and automated as possible.
All right, another super question. Lucky you.
Why not? Throw them away. Throw them at me.
Your video said that I could contribute $72,500 to superannuation because I can use something called Bring Forward. Do you want to explain?
Love to.
How we got to this $72,500 amount?
Yeah. So particularly for younger people, or let's say 30 to 40 to 50-year-olds who starting out slow with their superannuation balance, if you have what they call a total super balance of under $500,000, you are able to access what they call a you can do a bring forward, or you can do a catch-up contribution for missed opportunities in terms of reaching previous year's caps. So for the last 3 years, we've had this $25,000 cap. And if you've only been putting in, say, $15,000 or $10,000 a year, each year where you had a gap of unused contributions, and let's just say it was $15,000, if you're having a really successful year this year, you can access those previous year's caps that you didn't utilise. So it could be $15,000 one year, it could be $10,000 another year, and it could be $20,000 another year, as well as your current year cap. That's how we get to that $70,000 concessional contribution that you can make, and is then tax deductible to the business in this current financial year. So if business is doing well and have the cash flow to be able to afford it, it's a pretty good outcome for you.
Agree. All I heard is that 72,500 is a great calculation. 27,500 next year plus 3 years of
absolutely
super not done. All right, the next question. I'm interested in your thoughts on the likelihood of interest rate increases, given that the Australian banks borrow heavily on the overseas markets. The American bond rates are increasing due to the pressure on heavy borrowing of the US Fed. If that happens to us, will Oz follow? And will we be advising caution to our clients and, if possible, to lock in the low rates for as long as possible? And Chris wants me to have a go at that question. Chris, I did all the ones at the beginning of the session. Alan's just jumping in with the super at the end.
I'll just be quiet now. Over to you, Steph.
Look, I think it doesn't make economic sense that our interest rates can continue to stay as low as they currently are. We do obviously have a lot of government spending. There's a lot of stimulus still happening in the economy. The government clearly from last night's budget wants people to spend. Right, this is a spending budget. We are going way into deficit. We're going to have an enormous amount of debt as a country. But the idea behind that is that we continue to prosper, we continue to actually develop, we continue to innovate, we continue to be, I guess, a self-reliant and a little bit more agile country in some of the grants and things that they're bringing about and offering. So in my mind, it just doesn't make sense that interest rates can stay where they have. I agree, we always follow trend from everywhere else. Our borrowing is going to get higher, in which case that's likely to have that effect, that interest rates are going to increase. And at the end of the day, it's always good to lock in at that lower interest rates when you have the opportunity to, and there's so much uncertainty. So, you know, if we were having this conversation 12 months ago from an economic forecast standpoint, the conversation we're having with everyone is we don't know what's happening next week. We certainly don't know what's happening next month. Therefore, if you have an opportunity to throw caution to the wind, 100% be caution, but take those opportunities that you know you can deliver on where other people won't, because they won't take that risk. So it's easy to lock in those interest rates because it's easy to understand that you can meet those repayments and that you're not going to get yourself into hot water if interest rates suddenly do start to skyrocket. So we do have a lot of people who are locking in. And I think that is definitely a wise idea. Unless, of course, you're Alan, who likes to gamble and would pick red, black at the casino, and so likes his rates to be a little lower. And that is definitely not financial advice. So if you want to go black, red, that's...
Look, I mean, you have to also remember too, I mean, I bought my first house in 2007, actually, for the Novocastrians in the audience, just after the Pasha Bolka weekend. And we had, I think it was 6 or 7 interest rate rises in a row, which is, 12 years ago, but I was paying up over 8.5% interest rates. So they definitely can rise, and they can rise pretty quickly. Like, I think I actually had my first interest rate rise before I made my first repayment on my mortgage, which was a bit devastating. But anyway, I think just to back onto what Steph's saying, and thanks for the question too, Chris, but if you're going to plan, particularly for a business, to invest into your business, and usually that's through loans, we like to do it with looking at interest rates, a minimum of 5 to 7% over the longer term, because we do know that interest rates are low now, but they're not going to stay like that. And if you really are going to be cautious and know that you can afford your commitments, then we do look at those higher rates as a standard so that we know the risk level that people are entering into when they go into those debts.
And I think the reality is, none of us would have been sitting here this time last year suggesting that as an economy we would be in this position that we're in. And that businesses would be in the position that they're in. I mean, last year we were not even realistically worrying about tax planning, and the conversation for the last couple of weeks for all of our clients have been, holy crap, look at all of the profit. What
Nice
are we going to do?
Yeah.
Fantastic problem to have, but I don't think any of us would have predicted what has happened, and especially in Newcastle, in terms of business and how well some people have done.
All right.
So the last question that we'll probably cover off on today is the deregulation package. And the question is, what the hell is a deregulation package? So this was another one of those announcements under government spending, you'd probably put as a heading. And it really is the government aiming to make it easier for businesses to employ people and making it easier to meet the regulatory burden. So I don't know if everyone feels the same, but we certainly hate anything to do with modern awards and calculating pay rates for people, because literally you could be on the pay calculator for 2 hours doing 5 different permutations because you've got 3 people who, are slightly different in their apprentice start date or age or high school finishing and all of the rest of those things. So wading through that information is really hard, and it's also stuck in the government's Fair Work site. So there's been a bunch of money that is literally being given to the government, so 10 million, that's going to go towards developing technology that literally helps employers interpret and comply with the modern awards. So effectively, they're going to open the Fair Work API, and software developers will be able to tap into that Fair Work API, download the information that they need to, and everything could, in effect, be in your software solution that mirrors everything in the Fair Work Modern Awards. And when those things are updated, it would automatically update your payroll software at the same time. So this is massive for small businesses. Most under Modern Awards are used to a 1st of July pay rise for their employees. And, you know, we all run around mad trying to make sure that we've got everything sorted. But last year, obviously, so many industries were deferred. We saw 3 different types or dates of when those pay rises happened. And I think everybody is just as confused as ever.
Yep.
So again, that'll be fantastic just to ensure that small businesses aren't kind of left in the cold and having to go to this one website that's government clunky old and doesn't integrate with anything, and you have to manually update every single year as well. So that would be amazing. Fingers crossed that Xero gets sorted with that API. And
amazing. It's a massive missing link in that employment phase of a business. When you're looking at staff, you have so many other things to worry about when you start. You've got employing them, the awards, but you've got pay rates, you've got setting up on your internal systems, you've got training them in the way you operate your own business and making sure that they're a good cultural fit for you. If you have one less thing to worry about in that space, it's got to be a step in the right direction.
Yeah, it's very disjointed at the moment. So hopefully bringing that back will help. And I guess, you know, anything else that they can do, we're already lodging single touch payroll. We already lodge payroll weekly, fortnightly or monthly with the ATO. So, you know, closing that loop would be fantastic. It'd be great that, you know, when you lodge your STP, we no longer had to do instalment activity statements and all of those wonderful things. So wishful thinking.
One day.
Maybe that'll be budget next year. There's my prediction. Let's maybe 3 or 4 years time, but that will be fantastic. So it's bang on 6 o'clock. There are a couple of other questions, but we'll keep answering those on Facebook and on our blog. We'll have this video as a wrap-up video because I know a few of you have been jumping in and out as you've gone through. We'll have that out in our normal weekly Ninja News on Friday. But thanks everybody for their questions and tuning in. Hopefully you had some entertainment with the funny questions that were asked, and the serious ones we were able to help you understand and sort out where you're up to and what benefit or not benefit you're going to have. So after a very long night of reading the budget papers, I think Alan and I are going to enjoy a nice nap. So signing off for now. Thanks for tuning in.
Thanks everyone.